This insight covers the fast emotional response that can follow a loss when the trader wants the pain gone now. The impulse is often less anger than humiliation, and the trade that follows is usually trying to repair self-image rather than express a valid edge. A revenge trade is not just a trade after a loss. It is a trade that tries to erase the feeling of the loss. The market becomes secondary to the need to recover face, recover money, or recover control. What looks like aggression is usually injury. The trader does not return because the setup is strong. The trader returns because the bruise still hurts, and action feels better than waiting. The mechanism is emotional compression. A loss can shrink attention until only the deficit matters. Instead of reading structure, context, and probability, the trader reads the account balance and the internal insult. The next order is then chosen as a response to pain rather than as a response to edge. That is why revenge trading often happens fast. There is no room for review, no room for calm, and no room for the normal process to slow the hand down. The mind wants to reverse the emotional outcome in the shortest possible time. The signs are usually clear once you know what to watch. Position size gets larger than planned. The setup quality drops. The trader starts taking entries that would have been rejected in a flat emotional state. Stops feel temporary, targets feel negotiable, and the plan becomes flexible in the wrong direction. Sometimes the trader switches timeframes or symbols to find a faster path back. Sometimes the trader tells himself that this trade is only to get back to even, which is exactly the signal that the trade is no longer about edge. Revenge trading must be distinguished from disciplined recovery. A trader can take the next valid setup after a loss without revenge being present. The difference is motive and sequence. If the setup is valid, risk is unchanged, and the decision would have been taken even without the prior loss, then it is not revenge. If the prior loss is the real reason for the trade, then the market is being used as emotional compensation. That distinction matters because revenge trading often masquerades as determination, confidence, or professionalism. In reality, it is a short circuit between pain and execution. The cost is rarely isolated. One bad trade is not the main damage. The main damage is the chain that follows. Revenge trading tends to increase size, loosen discipline, and reduce selectivity all at once. That combination turns a manageable loss into a session problem. It also changes how the trader interprets the day. A single loss becomes a reason to fight. Then the fight becomes a reason to keep trading, and the account begins to absorb the emotional cost of wanting to be right more than the statistical cost of being wrong. The internal language is often the clearest warning. The trader may say that he just wants it back, that the market owes him, that the next move will fix the session, or that stopping now would feel weak. Under that language sits humiliation more than anger. The trader is trying to restore self-image through the next click. That is why revenge trades often feel urgent and morally charged. They are not merely about profit. They are about not leaving the wound exposed. The correction is procedural and immediate. After a loss that carries emotional charge, the best response is to reduce the odds of impulsive action. That can mean stepping away, ending the session, reducing size, or requiring a full checklist before the next order. The rule should be simple enough to survive the moment. If the only reason to take the trade is recovery, do not take it. If the trade would still be valid with no emotional residue, then review it as a normal setup rather than as a repair attempt. The goal is not to suppress feeling. The goal is to stop feeling from becoming execution. Revenge trading promises relief, but it usually converts a bruise into a more expensive bruise. It narrows judgment, punishes the account, and delays the real recovery, which is not getting even with the market, but returning to a clean process. The trader who can recognize the impulse early has already recovered part of the edge, because the market no longer gets to decide what happens next. The trader does. The healthiest check is simple. If the only reason to re-enter is the previous loss, the trade is already contaminated. A valid setup still has to earn its place. When that rule is respected, the trader can recover slowly through process instead of trying to recover instantly through emotion. That discipline is what prevents the account from paying twice for one bruise. It also keeps the session from becoming a debate with pain. If this spoke to something real in your trading, we'd value your perspective in the comments. Stay connected through bitaTrader.com's channels for more insights on discipline, emotion, and execution.